but let's go next level. Let's approach them with a conversation of, hey, what is a way that I can write this contract that's going to keep money in my pocket? So we look at things like, the seller paying for the title policy. That's easily could be a couple of $1,000s. Um, Seller concessions. So this would be money that the seller would contribute towards your closing costs. So that's going to be bank fees, title fees, the prepays for your taxes and insurance. So the money that you'll need in reserves, which is usually about 3 months for taxes and insurance, because you're going to skip your first payment typically. So you've got to have money already into that account for that skip payment. They put some cushion in there so when it comes back to the next year, those bills can be paid. There won't be a shortfall. I'm sure you know how that works, but just in case. And then your first year of homeowners insurance. A lot of times we're seeing, closing costs anywhere from 3 to 5%, depending on where the pricing of the loan is. That could be a little bit higher. So, what is allowed on a 10% down second home occupancy loan is that the seller can contribute up to 6% towards those closing costs. So, one thing to remember there, though, is you don't want to leave money on the table, because that money, if it exceeds the down payment, or I'm sorry, if it exceeds the closing costs that I just mentioned, closing costs and prepays, that money cannot go towards uh, your down payment. So, you just want to make sure that you're very in tune with your loan officer on what those closing costs are, before you go into a contract proposing that they pay, that very limit of 6%, because you just don't want to leave money on the table. Now, it could be that you could talk to them about paying points, or what would it cost to buy down the interest rate, include that in your closing cost to get up to that 6% potentially. You just want to be aware of what that amount is so that you're not leaving money on the table.